it's important to understand that, if you have projects that are placed into service now and you're the tax beneficiary, that you might want to look into doing a cost segregation to enjoy that 100% bonus to hopefully create some NOLs that you can utilize with that 5-year carryback.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrick Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today in the Buzz House, Garrick and I will be discussing a number of tax-related topics that can enhance and add value to your affordable housing project, many which have timing considerations or percentages that are changing. These topics will range from bonus depreciation and utilizing cost segregation studies to 45L energy efficiency credits to understanding the changes in HUD-designated QCTs, among a few other items. Before jumping into today's discussion, we want to give you a few updates from around the industry. On October 29th, the IRS published a notice of proposed rulemaking on the Housing Credit Average Income Test for public comment, otherwise known as income averaging. The Consolidated Appropriations Act back in 2018 allowed for a new minimum set-aside, in addition to the 20% of your units at 50% or 40% at 60%. The third minimum set-aside, of course, is at least 40% of the units, averaging no more than 60% of AMI, with a max of 80% AMI. If a unit goes out of compliance for any reason, the proposed rule would provide the taxpayer up to 60 days after the year end, in which the average was violated to take mitigating action and prevent the project from violating the minimum set aside. So that was a big concern, is how you'd be able to mitigate any violations with the rules. Comments are due to the IRS 60 days after the publication of the proposed rule in the Federal Register, which we expect to be soon. So please be prepared to give your comments to the IRS here by around year end. Not directly related to rental housing, but which could have an impact on the need for rental housing, is as of October 18th, here in 2020, roughly 3 million homeowners were in a forbearance plan, according to the Mortgage Bankers Association. This forbearance plan, of course, was available under the CARES Act. As these homeowners exit forbearance, they will be vulnerable to foreclosure. The American Bankers Association Banking Journal discussed some of the options that servicers may deploy to prevent homeowners from going into foreclosure, such as repayment plans, payment deferral, partial claims, and loan modifications. Finally, regarding low-income housing tax credits and taxes and bonds, the IRS recently came out with the annual per capita amounts of credits and bonds. The amount of 9% low-income housing tax credits per state remains the same as 2020, and that's 2.8125, so 281 and an eighth per capita. The small state minimum increased about $28,000 over 2020 levels to a little bit more than $3.2 million per year. Some good news on the taxes and bond side is that the bond per capita multiplier will grow from $105 per capita to $110 in 2021, or about a 4.7% increase. With more and more states reaching the maximum allowable bond allocation, this increase is welcome news around the country. Actually, one quick update on a state credit, as we're seeing more and more states passing credit legislation. The Pennsylvania legislature recently passed a state low-income housing tax credit. The next step is for the state legislature to authorize funding for the credit. We'll provide updates on this credit as it moves forward. Now we're ready to get into the crux of our presentation and discussion today. Garrick and I will jump into discussion around opportunities for your project and some considerations. With that, I'll turn over to Garrick. Garrick?
Thanks, Don. So I'm going to go over basically a couple of things, and most importantly, what's going on with bonus depreciation. So the 100% additional first-year depreciation deductions was created in 2017 by the Tax Cuts and Jobs Act. And generally, it applies to depreciation of business assets with a cover period of 20 years or less. So in real estate transactions, typically this would include your site improvements and your personal property. And so it's been great to have this 100% bonus here, because a lot of low income housing tax credit deals and investors are sort of dependent on those after tax benefits. And then a lot of owners of multifamily, let's say market rate, who are the beneficiary of those losses, can utilize that 100% bonus to enhance the losses going to them, to hopefully offset income elsewhere. And so the reason why I bring this up is because these bonus depreciation percentages are going to start decreasing soon. So right now we're at 100% bonus, and that's going to go through 2022. In 2023, it's going to reduce down to 80%, and then 60% in 2024, and then 40% in 2025, and 20% in 2026, and then 0% 2027 and going forward. Absent any changes in Congress with tax law that would maybe reinstate it. And so why is this going to be important to folks? Because it's about tax planning right now. There are things you can do to enhance some additional benefits of upfront losses, known as cost segregations. And so under the United States tax law and accounting rules, a cost segregation is basically just a process of identifying, personal property or short life assets out of the group of sort of real property assets and separating them out. And basically, given the fact that you're pulling more of the assets which you would have classified as building, for instance, into the short life assets, they're going to be eligible for bonus depreciation. And therefore, right now that you have 100% bonus depreciation, it's great. If you can pull out 20% out of that building, you can generate some pretty nice first year losses. And even as these depreciation percentages decrease over time, like I just mentioned, a cost segregation might just be the tool that you really kind of have to use to get to the level of losses that maybe you would, that you're trying to achieve for purposes of achieving the benefits to the investors that are being required. On the personal side, you have the CARES Act, which basically, in summary, it removed the 80% limitation on the use of NOLs enacted by the Tax Cut and Jobs Act with respect to NOLs that are carried to any taxable years beginning before January 1st, 2021. So this is key, right? Because, now that it's sort of pushed that off, well, you could go out and do a cost segregation on an asset that you're getting these tax benefits of and enjoy the 100% bonus appreciation, and can create an NOL that is not limited right now. And in fact, it's actually up until the end of 2020, you can actually carry back these NOLs for 5 years. So after 2020, we're going to go back into the Tax Job Act rules, which are going to have that 80% limitation, and they're not going to have any more 5-year carrybacks. So it's important to understand that, if you have projects that are placed into service now and you're the tax beneficiary, that you might want to look into doing a cost segregation to enjoy that 100% bonus, to hopefully create some NOLs that you can utilize with that 5-year carryback. Baker Tilly has a robust cost segregation practice, which we can help you analyze and determine those after-tax benefits of that study on your assets. So, give us a call if you have any questions about that. I have some other things I'll cover, but I'll go ahead and let Don discuss a couple of things that he wanted to discuss as well.
Thanks, Garrick. That was really, really good and timely information. Kind of watching that those percentages on the bonus depreciation and so forth. One thing I just want to touch on that we recently mentioned in a previous podcast, but I'll get into a little bit more detail, is that at the end of September, 2021 QCTs and DDAs, or Qualified Census Tracts in difficult to develop areas, were just released by HUD for 2021. Of course, projects in QCTs and DDAs will allow for up to 30% basis boost for your project, right? Creating additional eligible basis, which you'll earn tax credit equity on, can be very helpful. The new designations apply to properties that receive a 9% LIHTC award and are placed in service on or after January 1st, 2021. And also for tax and bond projects, the DDAs and QCTs apply to these projects where the building is placed in service also on or after January 1st, 2021. What it really behooves you, though, as a developer, is to look at a project maybe you're underwriting and haven't submitted yet for your tax credits, and make sure if it is in a QCT or DDA today, sometime in 2020, that is still on the DDA QCT designation list in 2021 to be able to see if there's an opportunity to preserve the boost if it in fact is no longer on that list. I'll walk through a couple steps that would allow you to preserve this basis boost for either 4% or 9%. We've done this with a couple of our clients on 4% projects. So let's say you're currently looking at a 4% deal. It's in a QCT today. You look at the list, it's no longer on a QCT list. What you can do and how the code reads is that if you submit a full bond application, it must be submitted to the entity which issues your taxes and bonds if it in fact is different than your state entity which allocates tax credits. So again, a full application submitted by December 31st should secure your basis boost for 2021. Again, be cognizant. Different states might have different rules. Some might say you need to submit your bond application 15 days before year end and so forth. So definitely check in with your state housing agency if you're in the situation, and also check in with Garrick and I to see if we can help you with that. Likewise, for 9%, it's probably a little bit more difficult in practice. Technically, you're able to submit, again, if you submit a full tax credit application on or before December 31st, 2020, and your development receives a LIHTC award within 730 days, so over 2 years of your application submission, you would actually meet these rules to be able to preserve your QCT and DDA boost. Of course, this tends to be a little bit more difficult because prescribed due dates for applications, changing QAPs and so forth. So a little bit more practical would be that 4% scenario. But again, just you hate to move forward and all of a sudden you lose your boost. That could obviously make your deal no longer pencil out. Speaking of taxes and bonds, one other item we want to talk about a little bit further, and very key for listeners working in states that have run out of tax and bond volume cap recently, which is a growing list. States like Texas, Georgia, Tennessee, Minnesota, among a handful of others. A piece of legislation we're keeping our eyes on is the bill recently introduced in the House. It's entitled Support Allowing Volume Exception for Federally Assisted Housing Act. So kind of a long name there, but essentially it's looking at public housing projects and other federally assisted projects pursuing 4% tax credits and tax and bonds. The taxes and bonds they would utilize would not come out of the per capita authority that I referred to earlier, that going up to $110 per capita. It would not come out of that pool of volume cap. That means many more bond deals, right, will get done. So again, it's public housing, it's other federally subsidized properties. So it comes really not out of the per capita pool, which then obviously allows many new construction projects that were maybe formerly on a waiting list behind RAD or HUD deals, public housing deals to move forward. We haven't done, I don't think the industry has done a calculation of how many deals, more units this would free up, but we can be taking a look at that in the coming weeks and months as well and following this legislation. You know, somehow if you could cap this together with a fixed 4% tax credit percentage, you know, the number of units is going to be immense that would be new to the market. So some very exciting legislation being discussed that, of course, we'll keep you abreast of as well. I'm going to turn it back over to Garrick for a couple more updates. Garrick?
Thanks, Don. Yeah, I just want a couple of things that affects some of the real estate transactions that we work on that are basically expiring or the percentages like the depreciation is sort of shrinking. And two of these are key ones are the 45L energy efficiency tax credit and the solar credit percentages that are changing. So the 45L energy efficiency tax credit is basically a $2,000 tax credit for each newer rehab energy efficient dwelling, which can include an apartment unit or sort of a single family home, et cetera. And you got to make sure it's first leased or sold by the end of 2020 because it was retroactively extended to the end of 2020. So that's still around. I mean, you can obviously go back and amend returns to put on the 45L tax credit. You know, you got to get an engineer to get it studied and make sure that it met all the requirements. And once it does, you get these certificates, you can go ahead and get that $2,000 per unit credit per unit. There is a corresponding basis reduction to it. So if you're doing these on low-income housing tax credit deals, you just have to make sure you consult with your tax advisors to make sure how it would play out in that situation. As far as the solar tax credits, For 2016 to 2019, it's been 30%. But now that we're in 2020, so owners of new residential commercial solar projects are only going to be able to deduct 26% of the cost of the system from their taxes. And then in 2020, owners of new residential commercial solar are going to be able to deduct 22% of the cost of the system from their taxes. And then 2022 onwards, owners of new commercial solar energy systems can deduct 10% of the cost of the system from their taxes, and there is no more federal credit for the residential solar energy systems. So those are two things that I see on multifamily and even commercial properties that we work with that are notable, that are kind of going away or tearing down. So, like I said, please consult your Baker Tilly tax advisor if you're in contact with them, as whether you could qualify for 45L tax credits, or to give you some background information on how that solar percentage decreases are going to affect your project. Don, I'll turn it back over to you.
Perfect. Yep. Thanks, Garrick. And just one last item before we wrap up today's Buzz House. And we talked a couple of times over the summer and spring around refinancing, but it is something we do not want to lose sight of. And rates continue to remain low. They rise and fall a few basis points here and there. But we just recently worked with a client refinancing a multifamily project around 78 units, just closed with a 2.93 rate, so under 3% with the Fannie Mae refi. Fantastic rates. The lender we worked with said they had not closed the Fannie deal with a rate under 3. So, and that was just about a week or two ago. Clients that are getting quotes on HUD 223F loans right now are in the mid 2s. We've kind of reported on that earlier. Bank financing rates also at historic lows. I think where we're seeing opportunities that I don't think developers would have really considered in the past are deals in the midst of their 15-year like-to compliance period, right? You close the deal, you have fixed financing for 15 years, you go through the 15 years and then you have a capital event at that time. But if you did a deal 8 years ago, 11 years ago, 7 years ago, that interest rate in your debt's probably 5.5%, 6%. If you're able to get rates at around, give or take 3, even if you're at 3.5, you could save 200 to 300 plus basis points. We're seeing deals considering $500,000 prepayment penalties, $1 million yield maintenance, which again is a deduction. Obviously when you're going through these refinances in a tax credit deal, you have to look at how it's going to affect your syndicators, tax credit investors, IRR, and so forth. With a big write-off for a prepayment penalty, it a lot of times it's still going to make sense. Again, reach out to Garrick and myself. We can obviously help you look at the loan sizing, but think through the considerations with your limited partner and so forth, and how to make all the numbers work and have a win-win-win. Obviously, additional cash can go through the waterfall, lower debt service payments, higher DCRs, more cash flow, just many benefits as we work through the pandemic in many cases. And with that, that's a wrap for today. And listeners, thank you for tuning in. Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.